Inflation is coming down, by the way. And having said that, the target is 2%. So he's not there, but he's making progress. Now, Wall Street's saying, you're done. You did it. Mission accomplished. Inflation is coming down. You got what you wanted. Give it time. Stop raising rates. You're going to kill the economy. But the Fed is saying, well, we actually don't know. We can't untangle it. Yes, inflation is coming down. That's objective. But is it coming down because we're still raising rates? Or is it coming down because we're at the terminal rate?
In this video, according to Jim Rickards, the current state of inflation has sparked a debate on whether it's the result of the Federal Reserve's interest rate hikes or if the economy has reached what's known as the terminal rate. This is the point where the Fed believes inflation is under control. Wall Street and market indicators are suggesting that we might have already hit this terminal rate. However, Federal Reserve Chair Jerome Powell remains cautious, drawing from the lessons of history, particularly the Volcker mistake back in 1980. That was a time when rates were cut prematurely, leading to severe consequences for the economy. Rickards emphasizes the distinction between supply-side, cost push, and demand-side, demand-pull, inflation. Currently, it appears that supply-side factors, such as disruptions in the supply chain and rising energy costs, are driving inflation. Interestingly, demand-pull inflation, where consumers actively respond to rising prices, hasn't fully materialized. Now, here's where it gets interesting. The Fed, according to Rickards, may not be making a clear distinction between these two types of inflation. This caution, he argues, might be influenced by a fear of historical mistakes and a potential misunderstanding of the dynamics at play. In essence, the cautious approach of the Federal Reserve, as explained by Jim Rickards, is an intriguing aspect to keep an eye on. Stay tuned for more financial insights on Money Zone. Now, let's delve further into the world of finance.
Those are two different things. And right now, and this is what Powell's been saying, the Fed leans to the view that they're not at the terminal rate, that inflation is coming down because they're raising rates. They have not achieved the terminal rate. So Powell and the Fed have said, yeah, inflation is coming down, but it's because we're raising rates, not because we're at the terminal rate. We're going to get to the terminal rate, and then we'll pause. And then if we're right, we'll just let inflation come down on its own. And that may take a year. So all this stuff about the Fed pivot and cutting rates and all that stuff, I mean, the Fed's thinking mid-2024 before they do that. Now, Wall Street, and I'll say markets, not just Wall Street, but the big money in places like the Eurodollar futures curve and the U.S. Treasury curve, which are highly inverted, are saying, no, you're not going to get that far. You may be at the terminal rate already. You're definitely going to cause a recession. It'll be more severe than you think, and rates are going to have to come down sooner than people expect. In other words, you've already achieved the terminal rate. You just don't know it, and you'll probably be the last to know. So with Wall Street, with cheerleaders, sending that message, but with some serious market indicators, including yield curves, sending that message. Why is Powell sticking to the game plan as I described it? And the answer goes back to 1980, believe it or not, and what's called the Volcker mistake. And everyone knows, Volcker became Fed chairman in 1979. He stayed on until the early to mid 80s. And he did raise interest rates to 20% or very close to it to kill inflation, which went up to 15% at the time. But people forget that there was a recession in 1980. It was sharp but quick. It was over very quickly. It had nothing to do with monetary policy. The Carter administration issued some dopey regulation on a ceiling on credit card interest rates. And the industry said, fine, we're just not going to lend anybody any money. The economy fell instantly, kind of like a smaller version of what happened in 2020 with the pandemic panic. And then they said, oh, sorry, just kidding. And then they took the ceiling off, and then things got back to normal. Now, this was a time when farmers around the country were driving front loaders and tractors to Washington, and they were circling the Fed building. And one guy drove his tractor up the steps of the Fed, and Volcker was being burned in effigy. That all happened. So it was a little bit of pressure. And of course, Congress was up in arms and the White House was up in arms. So Volcker, not quite panicked, but he cut interest rates 7 percentage points, not 0.7, 7 full percentage points to deal with the recession, which, number one, was unnecessary because the recession was caused by a policy blunder from the White House, which was quickly corrected. And number two, he had not won the fight against inflation. Well, after he cut rates, and we came out of that very quick sort of snap recession. Inflation got even worse. And that's when Volcker had to raise rates to 20%. And Volcker, in hindsight, he said, we shouldn't have done that. We should have stuck to our inflation mission. So now Powell, remember, Powell's not an economist, he's a lawyer, so he kind of thinks like a lawyer. I can relate to that, looking at both sides. Powell does not want to be that guy. He does not want to be the guy who balks early and cuts rates, the famous Wall Street pivot, before the battle against inflation is won, because the outcome could be exactly what Volcker experienced, which is inflation wasn't done, doesn't go away, comes back stronger, and then you do have to destroy the economy, as we did in 1981-82. That was the worst recession. That was far worse than the little one in 1980. That was the worst since the Great Depression. We've managed to break that record several times since then, but at the time that was horrific. But Volcker and others have said that was a blunder he never should have done. So Powell does not want to give up the rate hikes too early because he does not want to repeat the Volcker mistake. He does not want to be that guy. And that's what's driving him, even as Wall Street screams, you're already there. So the question is, how does this play out? In my view, Powell probably is there. He probably is at something like a terminal rate. He probably doesn't have to raise interest rates anymore. He doesn't believe that himself. His models tell him otherwise because they're relying on the Phillips curve, which is junk science. I mean, the last time I looked at a Phillips curve, it was flat. At least where I went to school, curve was curved. This thing is flat. There is no correlation between unemployment and inflation. There just isn't. But the Fed thinks there is. So I always tell people, if you want to forecast Fed policy and understand the Fed, don't think like a rational person. You have to think like the Fed. You have to get inside their heads or else you're going to get it wrong. So they're looking at unemployment, which is the lowest. The unemployment rate is the lowest since 1969. Well, if you believe in the Phillips curve, then that's a sure sign of inflation. As I say, even though it's coming down, it's still pretty high. They think they have to keep fighting this fight. But here's what they're missing. Here's where it all falls down. Yeah, inflation as measured, CPI, PPI, personal consumption expenditure, core, non-core, year over year. There are like 20 different ways to measure it. It is coming down. But there are two sources of inflation. And it's going to sound obvious, but you got to separate them, the supply side and the demand side. Both result in price increases, but they have completely different dynamics. Supply side inflation is what we're seeing. It's what we saw in 1974 with the Arab oil embargo during the Arab-Israeli war when they cut us off from oil. And, you had to line up for gasoline. I lived through that. Now, and again, this is what my book Sold Out is about, the breakdown of the supply chain, partly related to energy, partly related to the war in Ukraine, partly related to the pandemic panic. As I explained in the book, it actually predates that. The breakdown started in 2018 with Trump's trade war. And then COVID made it worse, yes. Ukrainian war made it worse, yes. But it really started before that. So, of course, prices went up and people were trying to pay whatever they had to get what they needed. And energy prices were a big driver of that. So that feeds through as a form of inflation. The other kind of inflation is from the demand side. So the supply side is called cost push. Costs go up and they push it onto the consumers. The other kind is from the demand side. It's called demand pull. And basically consumers have a change in mentality. They're worried about inflation. They would say, hey, I was thinking about buying a refrigerator. Gee, I better go buy it today because if I wait for 6 months, the price is going to go up. Or apply that to anything, a new dress, new suit of clothes, whatever. And so you're pulling demand forward and it's behavioral. And that will also drive prices up. But they're very different things. Now, cost push can morph into demand pull. That's what happened in the 70s. It started from the supply side, but by the late 70s, 80s, and Volcker, which we've just been talking about, it had tipped over into the demand side. That hasn't happened yet. We've had the supply side inflation, the cost push. It hasn't yet tipped into demand pull. It hasn't really affected consumer behavior that much in terms of people anticipating more inflation. It could, but it hasn't happened yet. Here's why that's an important distinction. Cost push inflation negates itself. The old saying that the cure for high oil prices is high oil prices. So it tends to negate itself, whereas demand pull feeds on itself. Powell has not made that distinction. And if I'm right, I think I am right, and the evidence backs that up, this inflation will come down, not because the Fed is raising interest rates, but because higher prices destroy demand all on their own. So it does tend to depress demand, destroy demand, and hurt the economy. and then it slows down, and then the inflation comes down on its own. That appears to be happening. But Powell hasn't really made the distinction. He's fighting the last war. I hate to use a cliche, but he's fighting the Volcker war. Powell doesn't want to repeat the Volcker mistake. He thinks the battle's not won. He has to get to the terminal rate. In reality, he's probably already there.
So, there you have it. A deep dive into Jim Rickards' perspective on inflation and the Federal Reserve's cautious strategy. As we navigate these economic waters, it's clear that the historical context plays a significant role in shaping the Fed's decisions. The ongoing debate about the terminal rate and the distinction between supply-side and demand-side inflation adds layers of complexity. Stay informed, stay tuned, and if you found this video insightful, don't forget to click the subscribe button. Your support keeps this channel going. Until next time, happy investing.